take a look at, Joe, what's a very, very interesting market day as we've turned a bit. NASDAQ is now green, as is the Russell. So the Dow and the S&P obviously are well off their worst levels, and we're watching a number of different asset classes, from oil, of course, to the metals, et cetera. What are your thoughts here?
So I think you have to ask, what is the message in the price action that we're seeing today? And I truly believe that the market did a very efficient job in pricing in a premium over the last month for energy prices and for bonds. And for whatever reason, certainly equities were discounted over the last month. So that puts you in a position today where what could be perceived as a significant geopolitical shock that acts as a catalyst for a precipitous decline in risk assets is not unfolding. And we're kind of just back to where we were last week, understanding where the opportunities potentially might exist in the marketplace. I also think it's interesting that it is the Mag 7 that once again are coming to the rescue on a day like today. It is Apple, it is Nvidia moving higher, it's Microsoft, it's Alphabet. So if there is ultimately an equity safe haven, those names once again prove themselves to be exactly that.
The commentary, Mike Santoya, I'll come to you here just to lean on you for a moment, seems to be anything from briefly the markets will react, a geopolitical shock. You point out today in your original pitch of the day that these tend to be short-lived. Yes. In terms of a market impact.
And I think everybody had 2 days to sort of absorb the history of this, and it's eventually, and often not very long after the event, a buying opportunity. Nobody even allowed much of a dip to occur this morning before essentially buying it. I always try to ask, what do you think the market ought to reprice in the response to this kind of event? Brent crude going back to levels we saw last June was probably not going to radically alter the picture. As Joe mentioned, we have been sort of clenching up in advance of this. You had a 21 VIX going into the weekend when the S&P's been flattish. I do think it's, though, instructive to kind of see how the market's doing it today. More stocks are down than up. You actually have a mix of the sort of counter trend rallies in some mega cap tech, along with beaten up software and credit-sensitive investment banks, along with the usual energy going up, defense stocks going up. So the market's doing what it's been doing for a very long time, which is selling one thing to buy another, and essentially rotating away from danger and keeping us in the range. So I don't think we have any kind of an all clear based on the issues we've been grappling with for a few weeks, but you also saw not much of an exacerbating factor coming from what happened over the weekend.
The new variable, of course, is energy, which is being discussed as well. As you see, Steph, both Brent and WTI rise substantially today. Wells Fargo declares the worst case scenario for the market would be an S&P 500 falling to 6,000 if, in fact, you do have a significant oil shock. If you have a prolonged closure, they talk about, of the Strait of Hormuz, that you could see oil above $100+ a barrel. And then, of course, that would mean something more significant for the equity market.
So first, I think it's pretty remarkable that we have thrown so much at this market. Venezuela, SCOTUS, AI, software, banks, the whole thing. And guess what? S&P 500 is flat on the year. And the equal weight is up 6% on the year. And it speaks to a resilient economy and also speaks to just really strong rotational action that we're seeing in a lot of different groups. And it's and Mike, you mentioned it, that there are a lot of groups that are participating today. There are plenty that aren't, but there are a lot. It's not just Mag 7, it's financials. It is energy, some materials, some software. But that's actually a very healthy sign in my mind. So still have a lot of unknowns. You asked about oil. Watch oil. I actually thought, Scott, that oil was going to be up $10 to $20 today, yesterday at this time, and up almost $5. I mean, of course, oil has rallied 19% year to date in expectations, but if we got another $10 or $20 upside in oil, that would be very problematic. The other interesting note is that the 10-year hit 392 yesterday. It's now at 404. So that's sort of kind of interesting to me, too. Like, we're not seeing a massive panic.
Like the traditional safe haven run to bonds, and then you'd see yields fall. In fact, it's the opposite. Your points are well made.
And I would just say one last thing. Credit spreads. Credit spreads are okay. They're a little elevated, but they're nowhere near COVID, or they're nowhere near Liberation Day. So that, to me, seems like a pretty good outcome.
We'll have more just past the bottom of the hour on the fallout in the energy markets, the whole complex. When Mark Fisher joins us of MBF Trading, he, of course, such a great mind and a famed energy trader across the board. He'll join us with his insights and where he thinks all of that could be heading and how he is trading it. And we'll do that again just after 12:30. You know, Jimmy, I guess a lot of this depends on how long this persists. The president, you just heard, suggests could be 4 to 5 weeks. We have the capability to go longer if we need to. I thought it was interesting that the president told CNN within the last hour that the, quote, big wave is yet to come. So, you know, we're watching all of that, and that in some respects will dictate how these various asset classes move.
Yeah, and that creates a lot of uncertainty. I'm very pleased with how the markets have responded across the board today, whether it's equities, whether it's fixed income. Crude oil is honestly not that bad. Most importantly, the dollar has been stable. I thought that might be a referendum by the rest of the world on U.S. foreign policy, but it's basically flat. But 4 to 5 weeks for a military operation is a long time. This is not an overnight, over the weekend operation in Venezuela. This is not even Operation Midnight Hammer from June of last year. I think it was June. It was the summer when we bombed the nuclear facilities. And a lot can happen. The biggest wild card, I think, Iran is obviously trying to draw regional countries into the fray by attacking Qatar and United Arab Emirates. So far, they have been restrained in their responses, but you don't want to see this become a regional conflict. Right now, it's really just the U.S. and Israel against Iran. All of this being said, you know, we have experience over the last 4 years that really hot conflicts in places like Ukraine, Hamas, Lebanon, that these have not upset consumption here in the U.S. These have not upset capital expenditure plans here in the U.S., whether it's data centers or whether it's manufacturing onshoring. And a somewhat trivial point today, but would have been important if not for the weekend news, is the ISM manufacturing survey is nicely into expansion for the second month in a row, which indicates that there is very good economic strength here in the U.S., unlikely to be upset by the current events unless they get meaningfully worse.
Well, Joe, most are, you know, the commentary I read from this morning is a suggestion not to bail on the story. You know, and the story is that there's enough to build on to keep the market moving higher once you get past the obvious volatility that comes from times of war. Julian Emanuel of Evercore says more earnings plus more volatility equals more upside. Delayed, not derailed. He raises his S&P earnings estimates. There's a couple of notes from Ed Yardeni today that I thought were particularly interesting. We wouldn't be surprised if any sell-off in the morning turns into a rally. That's one thing. And then he also goes further and says in our short war scenario, of course, who knows how long this will progress, oil prices should fall in the coming weeks after a ceasefire, boosting consumer spending, benefiting global economies. The weekend's Middle East developments make us even more confident in our roaring 2020 scenario.
Yeah, I'm a little bit more aligned with what Mike said before, where I don't think you have the all clear here. I think you just get the pass on you don't break down because of a geopolitical shock. I think we continue to have what I characterize it as rotational volatility. That's been the story all year. It's not exit volatility. It's not like people are moving to the sidelines. So I think today it's just, all right, the geopolitical shock presents itself. We don't break down precipitously. You kind of go back to where you were. I don't know if I see us going very far on either side for the S&P 500 of unchanged. I think to Steph's point, the S&P equal weight, yes, that could carry itself higher. That seems to be where the leadership is so far year to date. But I just don't think you want to get too high or low in either direction. I think that's the story so far of this year.
That's because, Mike, you just don't know whether this is 4 to 5 weeks or 4 to 5 months. It's just too early to tell if it's a sustained conflict of that level of magnitude, which is why Barclays today suggests it's simply too early to buy any dip until you get a sense of how long this really could last.
Yeah, and I think that was premised on the idea we might get a little bit more of a messy downside open today and sort of wait for it to settle out. But I agree with that. I think you can go on the premise that the market at this point is building in an expectation that this is not going to be either long-lasting or particularly disruptive, whether through the oil price or trade flows or anything like that. And so, therefore, you test the news flow against that assumption, and you assume that the market would have to, adjust if, in fact it looks like it's getting worse or the disruption is starting to build on that. So I do agree. I mean, I think it's worth remembering that Friday, and who knows how much of this was anticipation of something over the weekend, it had a real growth scare feel to the market.
Sure.
I mean, it was staples, it was defensives rallying, it was a huge bid in bonds, and you do have parts of the cyclical trade have really fallen away. It's only industrials that are really holding up their end of the bargain. You have a 6-month chart of industrials, consumer discretionary, and financials on an equal weighted basis. That's what you have. You have industrials doing the work right now. It's not like the other ones are completely falling apart, but they're not really carrying the weight to the upside. So maybe that's opportunity, maybe that stuff's gotten cheaper, but I do think even today, you see travel stocks, you see consumer related, you see housing related, not really holding up.
Yeah.
Well, I mean, I want to ask about energy, want to ask about materials. Even if you strip away today because there's an obvious movement, don't you think that there was some positive momentum before today in those sectors as well?
Well, for sure. I just don't read that as principally about the domestic macro story getting better, right? So it's a global reflation trade. There's no doubt about it. We came into the year kind of positioning for that, and I think that was part of it. Plus, every sector that was underowned and really small within the S&P has received this flood of money coming out of tech. And if you looked at the charts of consumer staples, materials, and energy, it's the same chart. Like, they basically have had the same trajectory of move in the last, month or two. So I think that's why the other dynamic, it's hard to pull apart what the macro story is in energy and materials aside from reflation, commodities, supply, maybe we're going to get disruption.
We have seen a growth scare.
Right.
The Atlanta Fed tracker was at 5.3%, and it's now at 3%. And it could even go a little bit lower because January was really crummy for retail sales and auto sales. And you can blame it on weather. We'll have to see. So we are seeing a little bit of a growth scare. So it makes a lot of sense. I think, though, that you're going to see a rebound from the first quarter into the second quarter, especially as we get more fiscal policy from the one big, beautiful bill.